Hello, everyone. Today we're going to talk about an important concept in finance, forward contracts. You may have heard about futures, but forwards are slightly different. Let's explore what they are, how they work, and why they matter. A forward contract is a private agreement between two parties to buy or sell an asset at a specific price on a future date. The underlying asset could be a commodity like wheat or oil, a currency, or even stocks. Just like futures, forwards are used either to manage risk or to speculate on price movements. But unlike futures, forwards are traded over the counter, meaning directly between parties, not on an exchange. Here are the main features of forward contracts. Customization. Price, quantity, delivery date, and quality are fully negotiable. No daily settlement. Unlike futures, you don't settle gains and losses daily. Everything is settled only at the end of the contract. Counterparty risk. Because there's no clearinghouse in the middle, there's always the risk that one party might default. Flexibility. This makes forwards attractive for businesses with very specific needs, like unusual quantities or special delivery dates. Let's look at an example. Imagine a wheat farmer and a bread company. Today, wheat sells for $6 per bushel. They agree that in 6 months, the farmer will sell 10,000 bushels to the bakery at $6.20 per bushel. Outcome 1. If the market price rises to $7, the bakery benefits. It's paying below market, while the farmer misses out on extra revenue. Outcome 2. If the price drops to $5.50, the farmer benefits by selling above market, while the bakery ends up paying more than the going price. So, why do we use forwards? Hedging. Companies can lock in costs or revenues to reduce uncertainty. This is very common in commodities and foreign exchange. Flexibility. Since terms are fully negotiable, they're ideal for businesses with unique needs. Speculation. Some investors use forwards to bet on prices, but keep in mind they're less liquid and riskier than futures. To sum up, forward contracts are private, customizable agreements that allow businesses and investors to manage risk or speculate on price movements. Unlike futures, they don't involve daily settlements, but they do carry higher counterparty risk. Understanding forwards is key to grasping how modern financial markets really operate. This concludes our discussion about the forward contracts. Thanks for watching, and I'll see you in the next lecture.